As a country, we need to start teaching financial literacy as a curriculum in primary school. Things about interest rates and inflation. When your money is sitting in a bank, earning 2-3%, and the rate of inflation in the economy is at 6-7%, you are worse off after 1 year. The central bank recently launched what they're calling the Dow CSD, which is a mobile app which you can download and then be able to invest in government treasury bills and bonds. Yeah, the Mamambogas, we are told they're the best paying when it comes to the M-Shwari loans. And the first principle of that is, if you're in a hole, you stop digging. And people have accused me of being a doomsday prophet. But I'm telling you, if things don't change, we will default on our debt. I think, and I'll quote Willie Mutunga said, this is a bandit economy. And Kenyans on Twitter are saying Kenya is a crime scene. And I totally agree with them. Thank you for the opportunity. So, my full name is Robert Gashurufa Githiri. The middle name is a bit of a rare name. I'm a Kenyan citizen. My background is in finance. So, I'm a career banker by profession. But in the process of being in the banking sector, I've also exposed myself to the literature that is out there. And I've been able to get a broad experience in the financial services sector, but on top of that, I've also acquired, I think, the requisite academic qualifications. My academic background is I've got an MBA in finance from the University of Sunderland. But besides that, I think my strength is in my diversity in the banking sector, having worked across all the major departments, starting off in retail, working in the branch network, and then moving over to the head office and joining the then called Treasury Department, which is now called Global Markets. And that's really where my journey into banking began, because prior to that, I was out there in the bank, in the branch network, but coming into the head office and being exposed to the Global Markets Department, there was another level of banking which I was not accustomed to, and there was a lot of learning, and in a way my career, my profession took a different trajectory there, and it was a blessing in disguise, but I'm grateful for that.
You have published a book.
Yes, I have.
Could you tell us which book this is and what is in it?
Okay, so the book is called An Introduction to Financial Markets. We have a copy right here. But there's a bit of a story behind this book and how it came into being, because it was not in my plan. It was not in my life plan or my bucket list, to say, to write a book. That was not in the plan. After I left employment, I needed something to do. So I took some time off and decided just to think about it. And everything was driving me towards my passion for the markets. So after quite like about 2 years, through a lot of introspection, and if you can say meditation, actually true, I came up with this idea to start a podcast. I really don't remember how that came about, but when you're doing introspection and meditation, things happen. So this idea came. I really can't remember how it came. So I started going to YouTube, looking at how to start a podcast, and I came up with the content, and eventually I started the podcast. I was able to come up with a name. The name of the podcast is the Market Color Podcast. Basically, what that means is that we give you a flavor of the color of what's happening in the markets. So I started the podcast over 2 years ago. This week I just did the 126th episode of that podcast. So it's released on a weekly basis, and it's just giving people an update of what's happening in the markets. That's what I used to do when I was working in the bank. So when I left, I decided I'm going to do this, but for a broader audience. So I was basically just sharing and telling people, this is the update for this week. This is what's happening in the global markets. This is what's happening in the local markets. This is information that will help you. So start the podcast, and I would release it on Sunday night, late Sunday night, Monday morning, sometimes when I'm a bit late. And then what would follow is a barrage of questions, by SMS, WhatsApp, people just reaching out and saying, congrats, this is good, but what did you mean by saying this? When you say treasury bill rates are this, what does that mean? When you say there's a new product which has been launched by the central bank called the Dow CDS, what is that? So a barrage of questions. So Monday mornings was spent just responding to questions. So it's out of those questions that this book was born. So, and I make that acknowledgement in the book, and I give credit to the listeners of the podcast, because they're the ones who instigated the book by asking questions. So as a result of answering those questions, I saw the podcast, while updating people on the progress, wasn't going deep enough in terms of explaining what the underlying foundation was. And that is why then I decided to write the book. The book is divided into 3 main parts. So in the beginning, we talk about the fundamental. We're talking about the basic concepts that drive markets. So here we are looking at the players in the market. We're looking at the central bank. We're looking at monetary policy. We're looking at fiscal policy. We're looking at international trade, but at a very basic level, giving you an introduction, a background, what it is, and then laying it out for you so that you get to understand. Once you get the fundamentals put down, you have the foundation of the house laid out. We then go to the next stage, and the next stage, that's where now we're looking at the specific markets. So we go a bit deep here. So the second part of the book, we're looking at the foreign exchange market. We're looking at the money markets. We're looking at the bond market. We're looking at the stock market. And here, like I said, we dive a bit deeper. So it's getting now, you're getting a bit wet at this point. And finally, we finish off by looking at, and I think this was very critical, looking at the past mistakes that have happened. So we do a bit of history, where we're looking at financial market stories, starting off in the 17th century in Holland, where there was the Dutch tulip mania, where people were selling their houses to buy flowers. And today we see kind of similar things, where there's a bit of irrationality in the markets, and we think that these things are new. So I take you back to the 17th century, and I show you whatever you're seeing in the financial markets today has happened before. So I share with the reader 9 stories about financial markets, starting in the 17th century, all the way to the global financial crisis in 2008. And we just look at the highlights. What are the key learnings? And the key thing here is for you to hopefully learn from the past so that you don't repeat those mistakes. So that's how kind of I've broken the book. And here we dive a bit deep, because, and the perfect example is exactly what you said, 2007, 2008, the global financial crisis, because that crisis was fomented by the financial institutions themselves. And it was greed. It was just pure greed, if you ask me. When we look at the analysis of what happened, it was the financial institutions that were overlending to the subprime sector in the United States. So they were lending to people who could not afford mortgages. They even called those mortgages subprime mortgages. So they knew exactly what they were doing. But because they had come up with these derivatives, which Warren Buffett calls weapons of financial mass destruction, and And they packaged these mortgages into bonds which they could sell to investors and be able to raise more money and lend still more to the subprime sector. So at some point it had to give. So for me, the learning there was there's need for regulation. As much as I don't advocate for too much regulation, I think there's a need. There's a need for regulation. The idea of free markets, it's not completely free. You need to rein in whichever industry, because sometimes greed gets the better of us. We must admit that. So that's what happened for me. That's my analysis. It was greed driven by the bankers, especially in the States. The bonuses, we've heard about the bonuses, the crazy bonuses that investment bankers were getting from selling these products, these repackaged mortgage-backed securities. So that greed is what drove and the collapse. Financial literacy is the ability to understand financial markets and the products offered therein. But you cannot have financial literacy, that is the first step, without financial inclusion. So there is a trust set up by the government called the Financial Sector Deepening Trust. And the idea here is to get everybody included into some form of finance, ability to access finance and ability to create, to access credit so that you can be able to grow your business and be able to, improve your lifestyle. So it's absolutely critical. But the good thing about Kenya, and I think here we are rated very well, it comes through the introduction of M-Pesa, where previously, I can't remember the exact survey that was done, but when we looked at the number of bank accounts that were in the market compared to the population, it was something like less than 20% at some point. But now we've gotten to a place where you don't even need that bank account, where your bank account now is on your mobile phone. So technology through the mobile phone, innovation through products like M-Pesa, Airtel Money, we've been able to make leaps and bounds as Kenya. So we're in a good place in terms of penetration, in terms of financial inclusion. It's not as bad as it was back in the day. Another piece of data that comes to mind is when you look at something like the number of mortgages in the market. The last time I looked at that data, there was only about 25,000 mortgages in the country. We are a country of 50 million people, and we only have 25,000 mortgages. That shows you there's a lack of access to credit. There's a lack of access to housing. So whilst we've made strides in that area, and we are much better off than many other countries, we still have a long way to go. The intention of writing this book is to play a part, to help play a part in increasing the amount of financial literacy that we have in the country. So whilst we have the M-Pesa, the ability to transact, the M-Shwari, the ability to save and also borrow, that is good. But there's another level, there's a hidden level that we still haven't gotten to. People need to understand now the investment side of it. Again here, and I've put it in the book, the central bank recently launched what they're calling the DAO CSD, which is a mobile app which you can download and then be able to invest in government treasury bills and bonds. Before, if you looked at the process that was involved, it cut off a lot of people. It cut off, your Mama Mboga, your Wanjikos. You had to walk to the central bank and open a central depository account. How many people know where the central bank is? How many people have the courage to walk into the central bank? Leave alone a commercial bank. It's intimidating, yeah, to walk into a bank and say you want to open an account. Leave alone walk into the central bank. So we have also made steps in that direction. Now, from the comfort of your home, you can be able to download that app and be able to go in and invest as little as, I think 5,000 shillings, yeah, 10,000 shillings. And you get into a 3-month paper, treasury bill, where you're getting interest rates at around 15-16%. And that's a good return for the kawaida mwananchi, because previously you were forced to go to the bank, open a savings account where you're getting 2-3%. So again, there, Kenya, I think, is leading the way. I don't think many countries have those kind of products. Banking by itself is technical, but I think there is a way you can break down the technicality and the difficulty so that everybody is able to understand. I believe the average person is well endowed with, some basic intelligence to understand something if you break it down in a way that is understandable. I think it was Albert Einstein who said, if you can't explain something simply enough, it just means you don't understand it well enough. So I think there's this thing of being technical, jargon, and all these things. And when you get there, it can be complicated. But I think if you are intentional and you want to communicate to that gentleman who's at the car wash, maybe he's a primary school dropout, not because of any fault of his own, it's because of poverty. But that man is brilliant. If you sit down with him and explain to him what the down CDS is and how it operates, and you take his phone and you show him how to operate, he'll be able to do that. We've seen that with M-Pesa. They're able to do that, and even much more. The mama mbogas, we are told they're the best paying when it comes to the Mshwari loans. They take the loan at 4 a.m., they go into the market, they buy their produce, they sell the whole day, and they're paying back their loans the same day. Before 9 p.m. they pay. They're the best borrowers, according to the data that Safaricom has released. So they understand. They understand money. They understand technology. So it's up to us in the industry to stop talking the jargon, to break down the language, go down to the people and talk their language, explain to them in ways that they will understand. People like James Mwangi of Equity has shown that there's a lot of money to be made at the bottom of the pyramid, and that is the basis of where Equity Bank came from. And they set up, and within a couple of years, they've been able to be one of the top 3 banks in the country by focusing at the bottom and talking the language of the local mwananchi. So I think it's possible, and it is indeed imperative that we get everybody involved. So for the guy washing your car, for Mama Mboga, for Wanjiku, yes, it is absolutely critical that we get them on board.
Now that raises the question of the method,
yes,
how we go about it.
Yes,
one of the attempts that have been made to include these people has been the so-called Hustler Fund.
Yes.
So, what are your views on that model of financial inclusion?
The idea is usually brilliant. The thinking behind it is awesome, but the implementation, that is where we go wrong. And then what's driving it? What is really driving that hustler fund? What is the intention of that? The political class saying the cost of borrowing for the mwananchi, even through the Mshwaris and whatever, was punitive. The products that the banks were making for mobile money lending was also quite prohibitive. The practices, and the central bank really cracked down on the mobile phone lenders who were adopting some unscrupulous ways of recovering money by sending very threatening SMSs to the people around you and exposing you and sharing your financial data and that kind of thing. So that is wrong. That is wrong. But getting back to the product itself, the Hustler Fund, the intention is noble. And there is a part where, we need to get these people involved. But the way it was done and the way the promise around it was more of a political gimmick. to get votes, if you ask me. So it was implemented, it was rolled out. I think the default rate on the Hustler Fund is worse. Is worse than all the other products that we have in the market. If you look at the banks, if you look at Jamuhuri. And so there was a reasoning why the banks were saying, and even M-Pesa was saying, the risk here of lending to these people is much higher, of course, than lending to maybe a corporate like East African breweries. But again, the political class had a point in terms of, we need to bring these rates down. These people can pay if they are allowed. So I think there was that initial getting everybody on board. I think most of that money is lost. I think the people who received, a big majority of people who received the funds, the way they perceived it, the way they received it, it was like, this is a donation from the political class for the vote that I gave to them. So really, that money is not going back. But there's still room, and we can make that product well, because we now have credit rating agencies. So you go in, you give your ID, they have your data. If you don't pay, you're listed. So that really curtails your ability to access credit. So if people really understand that there are implications for this, and this goes back again to financial literacy and education, telling you you're not getting away with anything. This thing will come back to bite you later on. So I think as a country, and I don't know whether there's any other country in the world that does this, we need to start teaching financial literacy as a curriculum in primary school. People need to understand money from the earliest. We're taught almost everything else, geography, history, science. If you drop a piece of potassium in water, it will burst, produce hydrogen, which if you put a flame, it produces a pop sound. That comes in the exam. You can name an insect, the parts of an insect. You can do the same with a flower. But there's what about money? Why do we spend 15 years in school at primary, secondary, before we go to college? We go to college, specialize, whether you're a professional, a doctor, a teacher, you come out, and what are you spending all your time doing? Acquiring that knowledge for what? So that you can be able to go into the market and earn what? Money. But have you been taught anything about money? Nothing. So there's a gap, and I think there's something we need to introduce into our curriculum as early as primary school, where we are teaching our children, the next generation, about money. Yes, what are the behaviors of money? How does money operate? Things about interest rates and inflation. When your money is sitting in a bank, earning 2-3%, and the rate of inflation in the economy is at 6-7%, you are worse off after 1 year. The amount of goods and services you'd be able to access after 1 year has diminished drastically. For the country to move forward, the country doesn't move forward as a block. It moves forward based on the people moving forward. So when we talk about development, we're talking about how are we getting our people to move forward. And the only way we can do that is for these people to understand how the markets operate, how the financial markets operate. Once they get a grasp of that, even a basic understanding, they're in a better position to be able to move forward.
From where you stand,
yeah,
which are the best ways of investing?
I would say it's good to have some funds available for emergencies. So I would advise, I'm not saying, go and close your bank account because you're getting 2-3%. No, you need those funds for day-to-day operations. So you need, and this is like a textbook principle, at least 3 to 6 months of savings that are readily accessible to you. And that's why you need that bank account to be able to facilitate day-to-day transactions. And the banks give you various ways to access that, whether it's a credit card, the automated teller machines, the branch network. So you always have access to money. You need to have that. The second bit is now where you go into your short-term investments. That's the second bucket. And this is where you're looking at short-term investments such as treasury bills. Now, treasury bills run from 91 days to 182 days to 364 days, so up to 1 year. And the rates that are currently being offered is between 15% to around 17%. With a treasury bill, you're earning way above the rate of inflation. And then the last bit is now where you get into the longer term investments. And this is where now we're talking about the capital markets. You're talking about bonds, long-term bonds from 5 years all the way to 15 years. You've got the infrastructure bond, which is very good in terms of the interest that you earn is exempt from withholding tax. So it's a good investment to have in the far end. So you've got your stocks, which are paying you dividends. And also here, we're also talking about your retirement account. Whether your employer offers one or not, you can also get a personal pension plan where you're putting in money for the long term. And there was an article in the paper the other day talking about the pensioners in Kenya not doing very well. In fact, I put it very politely. Pensioners in Kenya are not doing well at all. And it's because of the way that they invested. So you'll find people holding on to land, but day-to-day living expenses cannot be met. And then there's also not only the ability to liquidate that takes long. Selling land will take you a year, 2 years. Sometimes there's no demand for that. Yeah. So the ability to convert that into liquid asset for you to consume, very difficult. And then again, the attachment that people have to land. They will not let it go. And yet, they don't have any cash for day to day. So the ability to balance from, liquid cash, so where you have money flowing in on a daily basis. You have your medium-term bucket here where you're doing treasury bills and bonds, which are giving you a good return. Every 3 months you have some money, yeah? And then you're long dated where you have your stocks, your bonds, and your pension plan, which is also giving you something on a monthly. If you're able to split in those three ways, I believe we'll be able to better manage ourselves. And that goes again back to financial literacy, getting people to understand their time buckets. You need to spread out your investments. You can't just have everything in land as much as you love it. You need to diversify your portfolio. Yeah.
During investment, looks like you have to do some fundamental and technical analysis.
Yes.
So what are those, and how can somebody who is not very literate be able to do that?
The thing about fundamental analysis is that it's a basic understanding of the economy. How is the economy operating? And what are the telltale signs of how the economy is operating? So you're looking at some key fundamentals in the economy. The first thing you want to look at is, even investors are looking at this when they're coming into the country. They're looking at the gross domestic product, which measures the growth in the products and services that our country is producing. So how is that growing? How is the economy growing? Is it stagnant or is it shrinking? So if the economy is growing, that's a good sign. At what rate is it growing? And then compared to its peers in the region, how is that economy doing? So that's the first thing you want to look at. The second thing you want to look at is interest rates. So if I put my money into a low risk investment like a government treasury bill, what rate of return am I getting? Okay, and then I compare that vis-a-vis if I was to put that money in a business. What is the potential return that I get from the business as compared to a low risk investment? Not risk free, because there's risk even to government bonds. So you compare those two. And then the third thing you want to do is ask yourself, what is the rate of inflation in this country? So what is the rate of increase in money supply. So how fast is my money losing value in this economy? Okay, so you want to look at that vis-a-vis the interest rate that you're getting on your bonds or from your business, and that has to be higher than the rate of inflation. And then as you look at that, you also want to look at the foreign exchange rate. That's also a key indicator of how the economy is doing. So if the country is performing well, it's able to balance between exports and imports, then the exchange rate will be relatively stable, and you'll be able, primarily as a foreign investor, to bring in your money and take out your money without a loss in exchange. So the foreign exchange rate is also a good indicator, and I think Kenya, over the past, I think 3 to 4 years, we have seen the foreign exchange rate telling us the true story about our economy. We've seen the exchange rate move from around 100 and, was it 100? About 100, yeah, all the way to 160, and then stabilize back down to around 130 where it currently is. But that's just a reflection of what's happening in the economy. Yeah, so all those are key indicators that will tell you how the economy is doing.
The issue of Kenya's national debt is a vexatious one.
Absolutely, yeah, absolutely. From independence, 1963, all the way to 2012, when Kibaki left the presidency. In 2012, our national debt was 2 trillion shillings. That was when Kibaki left. Okay, between 2012 and 2022, 10 years of Uhuru's presidency, the national debt jumped from 2 trillion shillings to 9 trillion shillings. We borrowed 7 trillion shillings in 10 years. Remember, we've borrowed 2 trillion shillings from independence until 2012. Okay? So in 10 years, we borrowed 7 trillion shillings. Okay, exit Uhuru, enter the current president. 2022, 2024, the debt has gone up by 2 trillion shillings. We're now borrowing 1 trillion shillings every year. So you'll hear the governor talking up the debt. You'll hear the IMF supporting the World Bank, saying our debt is sustainable. I beg to differ. There are key indicators that we look at in terms of the sustainability of a debt. The recommended threshold for emerging market countries is that your debt compared to your GDP, that ratio is called debt to GDP ratio, should not be more than 50%. Currently, Kenya's debt to GDP ratio is at 70% and climbing. That means for every 100 shillings that the Kenya Revenue Authority brings in as revenue, 70 shillings is going to repay debt. We're left with 30 shillings to run the country. How is that sustainable? It breaches the IMF recommendation of 50%, and yet we are still borrowing more. And the amazing thing is that the same organizations that say we are already in breach of the limit are still lending us more money. Okay, I don't know. So the issue of debt is, like you said, it is something that is just, it's going to break us. Unfortunately, it is going to break us if we don't watch. And the unfortunate thing is this, from what we are seeing currently, and I always say, for the country to turn around, it starts with leadership. It starts with the leadership. So if we are not getting the signals from leadership of this country that there is a change in the way we do business, then for me it's just a matter of time before we default. We almost defaulted on our debt this year. The debut Eurobond, which was issued in 2014, during Uhuru's tenure, the first Eurobond we issued for $2 billion was due for repayment. There was a bullet repayment of $2 billion, which was due in June 2024. Towards the end of last year and beginning of this year, there was panic across the government, especially the Treasury. How are we going to pay this back? Because, China has said no, enough is enough. You're already slowing down on your repayments. The IMF had also kind of turned their back on us. The international markets, with the US dollar interest rates rising, as the Fed Reserve was increasing the interest rates due to inflation in the States, the debt in the international market, our bonds, the rate on those bonds was just moving up, and it was in double digits. At some point, we went into the market. They were doing what they call a book building exercise to see whether they'd be able to get back into the markets. And the rates that they were being given by the investors was 22% to borrow in US dollars. So it was actually cheaper for the government to borrow locally. So at some point, there was some panic. And they were saying, if this continues, Kenya will default on its debt. And as at the beginning of this year, 2024, we were on that path. But things changed, and the outlook in terms of interest rates changed. The stance by the IMF also changed. That was key. Once the tune, but that again, for me, if you ask, is political. So we played good politics. So their view changed on us. The rating at that time kind of improved slightly, and therefore we were lucky to be able to go back into the international markets. And what did we do? We issued another Eurobond for 1.5 billion. To do what? Development? No, to pay off the maturing Eurobond. So we are borrowing from Peter to pay Paul. Yeah, and the first principle of debt is, if you're in a hole, you stop digging. But unfortunately, we continue to dig ourselves deeper into debt. The rate at which we're taking new debt is increasing. And like I said, there is no political will from the leadership to change the nature of our politics. Because if the nature of our politics does not change, I can guarantee you that Kenya, and people have accused me of being a doomsday prophet, but I'm telling you, if things don't change, we will default on our debt. We will default. And when that happens, that will be it. Because if you look at the countries that have defaulted on their debt, it's basically a basket case. Yeah, the country becomes a banana republic, yeah, which we've been accused of being. But that is what exactly is going to happen to Kenya. Yeah, because I can see there's absolutely no political will to change. It's just business as usual. You go onto Twitter, you go into the newspapers, and you're seeing scandals left, right, and center. Yeah. So, and yet the debt is so huge and so unsustainable that there is no room for jokes. But people are just business as usual, and therefore I am absolutely certain that we're already beyond the point of redemption. We will default on our debt. And Kenya will spiral into a financial crisis, a financial and economic crisis.
Could you paint us a picture of how it looked like after the default?
Okay, Ghana is a good example. So immediately you default, immediately it's announced, because you can get leeway from the IMF and the World Bank. You can get leeway from bilateral lenders like China, where you talk to them and they suspend the repayments or they prolong the repayment period. But with the international bonds, the Euro bonds that we issued, those have to be paid back on due date. Now, if we're not able to meet that obligation, the first thing that happened in Ghana is that the currency depreciated by 60% overnight. So we are saying the dollar to the shilling rate right now is at 130. So we are saying between today and tomorrow, Kenya announces, or the international investors announce that Kenya has defaulted on its Eurobond. The dollar shilling rate moves to 200 shillings. That's the first thing that happened. what's the same thing that happens? Central bank comes in and says, look, we need to restructure our debt. The treasury now comes in and says, the local debt. And this is where now the fallacy of that treasury bills are risk-free investments. They're not risk-free investments. Yeah. There's a risk to investing in government securities. It happened in Ghana. The Central Bank of Ghana took a haircut. What does that mean? They said if you have a treasury bond of a certain duration, instead of paying you 100 shillings for the bond that you have, we're going to pay you 70 shillings for every 100 shillings. So they cut off the principal. So we're not even talking about interest here. You're losing your principal. Yeah. So the government says we can't afford to pay you. Then the interest rates that we had offered you, if your bond was at 15, 17%, we are bringing it down to 5% or even zero. And there's nothing you can do. And that's a risk that happens. So that's the second course of action.
Does the haircut also affect savings in the bank?
Absolutely. Absolutely. No, but for the banks, what would happen for them is, I think, just bring down the rate of interest, because and the banks also get affected because a huge portion of their balance sheet sits in government securities. So they take a hit. When they take a hit, they are likely to pass that on to their customers. So they will say, we're not paying any interest on your deposits. Okay, you're lucky you won't. I didn't see any haircuts. The banks don't have that authority. I don't think they have that. So they just say no interest on your deposits, which is better than getting your investment cut or reduced, which is what I'm calling the haircut. So that's the second course of action. The third course of action now begins to hit the economy gradually, because your exchange rate has depreciated by 60%. All your imports then take a turn for the worse. What's the first thing that gets hit? Your fuel. You import fuel on a monthly basis. There's an open tender system where you bring in your large consignment of oil. Your oil, the price of fuel goes up by 60-70%. Once transport goes up, everything goes up. So what happens after all prices have gone up? Inflation shoots up. Yeah. So you have your inflation rate now at below 5%. It shoots up into double digits, 20-30%. Your money is becoming worthless by the day. As was happening in Zimbabwe, you could buy a loaf of bread in the morning for a certain amount of money, and in the evening go back to the supermarket and the price of bread has doubled. At one point, a loaf of bread, and this is data, this is real data, a loaf of bread in Zimbabwe was costing 10 million Zimbabwean dollars. You had to take a wheelbarrow of money to buy a loaf of bread. So, like I said, I'm not being a doomsday prophet. I'm just telling you what has happened in other countries. And if we don't watch out, this is exactly where we're heading. It's not rocket science. It's not. It's very simple. Our national debt will sink us.
Now, the question is, we have some of the best minds in government.
Absolutely.
Very well-trained technocrats,
Absolutely.
Economists in the treasury,
Yeah.
The economic advisors, the central bank, very well-educated people.
Absolutely,
yeah?
Absolutely. I couldn't agree
So
more.
what is the problem? Can't they see is a train and it's headed for the wreck?
That what you've said is very true, but I think politics overrides everything in Kenya. Yeah, we've been told we have the best laid plans, and we discussed this earlier on. We have the best laid plans, but implementation and execution is our problem, and it's because of politics. So you've got the best brains, but once somebody goes into politics, I think there's a requirement that you leave your intellect outside. Otherwise, you don't survive in politics. So yes, you've got your best brains, but the politics demands that you follow what the leader is saying. And in the process of following the leader, you can't think for yourself, or you're not allowed to think for yourself. Maybe case in point, the head of debt at National Treasury, I think a gentleman called Sirma, just before the crisis on the Eurobond was resolved, he resigned. He just said, enough is enough, I can't take this. Yeah, so at some point, there are some people who have principles and they just say, no, we're not doing this. Yeah, but there are very few. There are very few Kenyans who will stand for what they believe in. Yeah, yeah, and that's the unfortunate bit. That really is the unfortunate bit. We look at what is my personal gain. What do I get out of this? And in the process, you put aside your intellect. You put aside your brain and you decide to become a sycophant. You know exactly what is happening, but because you're gaining personally, your family is gaining, your relatives are gaining, then you turn a blind eye. But the fact of the matter is that they all know what is happening, but they're beyond caring because they have a personal benefit to it. And that is the problem, and that is what is taking Kenya down. Yeah.
I want to take you back to the trajectory of the national debt.
Okay.
You said that in about 40 years, we only took about 2 trillion.
2 trillion, yeah.
I'm just trying to put my arms around how we ended up with taking so few debts.
Yeah.
What is the source of that reticence?
Mm-hmm.
Why didn't Kenyatta, for instance, ask for 5 trillion shillings?
My thinking is this, and I could be wrong, but this is the way I think about it. At that time, we had one central government where the resources were controlled at the center, and then at the will of the political class, and that was dispersed to regions, and we saw that unequal development. The president's area was always favored and all these kind of things, and the inequality in development. And that's why we had the constitutional moment in 2010 where we decided, no, we need to have a devolved system of government where it's no longer power at the center, power is devolved, resources are devolved, give the counties the ability to grow and develop. But as we all know, what we just did was we devolved corruption. But for the central government, I think this was a challenge. This was a challenge that happened when Uhuru took over in 2012. And it's a legitimate argument in that a huge portion of the national government, as per the 2010 constitution, now has to go to the county government. So a huge chunk, tune of about 300 billion shillings out of the, say, 3 trillion, which is our normal average budget, about 10% was going to the county government. So it was a big hole in central government. So the whole process of adjusting to the new constitution, implementing the new constitution, that was expensive. But it also left that hole that was created by the county government. So there is a legitimate argument in terms of saying there was a new way of operating and the funds available to the national government was drastically reduced. So it could explain the increase in our borrowing. However, I tend to disagree with that argument to some point. Yes, there's a need to borrow, but to what extent? 7 trillion shillings in 10 years. And I keep saying, show me 7 trillion shillings worth of development. Yeah, I see an SGR, I see the railway, yeah. How much was that? The exact figure is not known, 300, 400 billion dollars, I don't know, yeah. Then show me the expressway, how much was that? Now 70 billion, yeah. Where's the rest of the money? I don't know, I'm just saying, I'm just shooting, yeah, just shooting ideas into the air, but I'm just saying, show me 7 trillion shillings worth of deposit of development, and I can't see 7 trillion shillings worth of development. So did we get to a place where we were using, and I think that is where we are, although nobody will admit it, where we are now in a place where we are borrowing to pay recurrent expenditure, which is against the law, by the way. You're supposed to borrow for development, but we've gotten to a place, if 70% of your budget is going towards loan repayments, you're only left with 30% to run government. You can't. It's not possible. So we are, and nobody will admit this, we are actually borrowing to finance recurrent expenditure, to pay salaries and pensions. Yeah, we're not even borrowing for development. There's no money for development, absolutely none. Yeah, so I think that's where we are, and it's a very unfortunate place to be, but that's a sad truth. The International Monetary Fund, the World Bank, those remain in place. I mean, they were set up after the Second World War. To the victor of the war, that was the United States, Second World War. They won the war. To the victor of the war goes the spoils. The world order we're living in is a structure that was created by the United States. And the bodies that run it is the World Bank and the IMF. They call the shots. They will continue to call the shots until such a time as there's a new world power. And world powers keep changing, which brings me now to the issue of de-dollarization. And this is something that people are again in denial of. I mean, our whole lifetime, the lifetime before, I mean, since 1945, and even before that, America has been the strongest country, both in terms of the military and in terms of finance and the economy, the largest finance. So they dominate the world. Their currency is the global reserve currency. It holds sway across the world. Everywhere you go, people are demanding dollars, they want dollars. So that has been the situation, and that continues to rule. However, history tells us that all great powers come to an end. There was a Roman Empire. It came, it dominated, it fell. All empires come to an end. Ottoman Empire was there, came and crashed. Persian Empire was there, came and crashed. Even the American Empire will crash. And usually it doesn't crash from external sources. It crashes from internal. And what will crash the American economy, again, is their own debt. But we'll get to that. Let's focus on the de-dollarization bit. So what's happening currently is that there's an awareness that the rate at which American debt is growing is unsustainable. The last time I checked, the US national debt was at around $35 trillion. That is the debt on their books. Now, there's something called unfunded liabilities. That is the obligation that the American government has given to the American people in terms of pensions when they retire and medical benefits if they get sick. If you include unfunded liabilities, the American debt could easily be in excess of $150 trillion. Now, if you look at the rate of growth of that debt, you can tell that by looking at the annual budget deficit. The American economy is running a budget deficit of $2 trillion US per year. That's the current rate for this year. Last year, they spent $1 trillion more than they had in their budget. This year, at the current run rate, they're going to spend, the American Treasury is going to spend $2 trillion in excess of the budget that they have. Their budget is around $3 trillion. Now, everybody around the world is seeing that. The Chinese are seeing that. The Russians are seeing that. The Indians are seeing that. South Africans are seeing that. And so they come together and they say, hey guys, we need to do something about the dollar. It's not sustainable. They can see that, but they don't want to come out openly because they are also heavily invested in the dollar. I think China is the largest investor in US Treasury bonds. They hold in excess of $1 trillion in US Treasury bonds. But they have been selling that off, not selling that off, but as they mature, they're not renewing. So their holding of US Treasury bonds is gradually decreasing. And the Americans can see that, so they're not taking up as much as they were taking before. So all these countries, the other large countries, come together and just say, this is not sustainable. The dollar we have in our hands is a fiat currency, like all other currencies. Its value is driven by the full faith and trust in the US government, but it doesn't have intrinsic value. Yeah. In 1971, prior to 1971, the US dollar was backed by gold. Yeah. That's what we called the gold standard. a dollar was equivalent to, you could exchange a dollar for, was it 35 ounces of gold or something of the sort. I can't remember the exact details. But the US dollar was backed by gold. 1971, Richard Nixon comes along and suspends temporarily the exchange of US dollars into gold. That temporary suspension of converting gold into dollars has been in place since 1971. Yeah? And that continues to happen. So the US economy is printing dollars like they're going out of fashion, you know. And the other countries are saying, no, this will have to give at some point. Economics will check in at some point. Whether it's a global reserve currency, at some point something will have to give. And that's why they've come together and said, we need an alternative. Now I can pay attention to comments from the Chinese leader, from the Russian leader, because they are superpowers in their own right, and they command a big section of the global economy. So when they begin to coalesce together and say, we need an alternative when it comes to trade, because this thing will give at some point, then you need to start listening to that. And that's where the term de-dollarization has come in, because countries are now saying, eventually the dollar will collapse. So before it collapses, can we find an alternative payment system? They're also moving away from the global SWIFT, which is a system that we use to transmit currencies across the globe, and they're coming with alternatives. Yeah, but the first step that they've taken is trade between countries, bilateral international trade, is being settled in domestic currencies. Yeah, as they are working on a currency that will be acceptable to all other players as an alternative currency, which now brings in also the issue of cryptocurrencies, which a bit shaky, but they're beginning also to play a significant role in terms of transfer of value across boundaries. So there's a lot of things happening, but de-dollarization, maybe just to come to an end of this, is it's a process. It's not an event that will take one, and that's, I think, where people get it wrong, where they say de-dollarization is not happening. Because it hasn't happened, it won't happen. America is still the largest economy, yes, I agree, spot on. But when you understand that de-dollarization is a process that takes time, and the beginning of the end has started for the dollar, when you begin to look at it that way, it's just a matter of time. It will take long. Some of the analysts have given an indicator that around 2026, 2027, there's a huge amount of US debt that's coming due around that time, during those 2 years, 2026, 2027. We'll see how that pans out. But most analysts are saying by the year 2030, the world will have shifted away from the dollar, into another currency. And the decline of the US economy has already started. So it's just a matter of time. But I'm sure people will have different views. I'm open to different views, but I am firmly of the idea that this movement towards an alternative payment system and an alternative payment currency is inevitable, and the reason for that is because America has been irresponsible in terms of the way it manages its budget deficit. There's always this rift between the Democrats and the Republicans. They can never agree on how to balance their budget, and therefore they continue to kick the can down the road, as they like to say. They never agree. They just continue spending more and more and more. And I think I'm reminded of a saying by a former US president who said that the reason we have $1 trillion debt that was in the 80s is not because we haven't taxed enough. I think we have taxed enough. The reason we have $1 trillion debt is because we have a spending problem. And Americans don't agree. They do have a spending problem. They need to cut down. But they've already promised their citizens, free medical, free this, but they don't have the money.
Do you think we over-rely on Americans as the role model for our development?
I think depending on the president who's in power. I think when Kibaki came into office, he showed us for the first time that there was an alternative. and he started turning to the east. And that's the first time we got to see, Chinese coming on board, and we saw for the first time actually some concrete development, the Thika superhighway, because the Chinese also again plus minus, because they don't have too many issues around human rights or corruption. You can't compare America with Kenya. And I think that conversation was had during an interview at State House between Uhuru and Mark Masai, and he brought it out very well. You can't compare. I think that the discussion was Japan has a debt to GDP ratio of in excess of 200%, and Kenya is only at 7%. So we can't. You can't compare Kenya to the United States or to Japan for that matter. You cannot do that, because America, remember, the US dollar is a global reserve currency. There is demand for dollars. So even as much as the US government is running those $2 trillion deficits and printing excess dollars, those dollars are in demand globally. That money doesn't stay in the US economy. It goes out into the rest of the world. Yeah. Japan is buying American debt. Like I said, China is the largest holder. Even Russia, even with this war, still a major holder, yeah, of US government debt. So there is demand for wherever you go across the world. The only currency that is accepted without question is the US dollar. So the fact that they're able to do that, and they're the largest economy, and their currency is in demand, it doesn't create inflation at home, and it doesn't put them under a lot of pressure. So they're able to operate in a way that is singular to the United States. Okay, we're in a catch-22. We're in between a rock and a hard place. So we have, in this place where 70% of our money is going to debt repayment, we're in a fix where we need to borrow. We need to borrow. But at the same time, and I think the IMF has tried in their own way to say, before we give you any additional lending, because we can see you're straining, here are certain conditionalities. Yeah, these are some of the things that you need to do, and we saw those conditionalities put in place in the Finance Bill 2024, which was rejected by the Gen Zs and Kenyans en masse through maandamanos. Yeah, so you saw all those proposals that were in the budget. Let's not kid ourselves. Those are not our proposals. Those are not proposals coming from the National Treasury. Those are proposals which have been recommended by the IMF, where they're saying categorically, if you want more money from us, so they're being tight. They know, they've seen other African countries default, and they can see Kenya is heading in that route. So they've said, if you want more money from us, these are the steps that you must take. These are the revenue-raising measures that you must put in place. Those were put in the finance bill, and we saw the American senators coming to witness the budget reading. Yeah, I don't know what they were doing in it, but anyway, they're welcome. Those conditions were put in place. Kenyans, without fear of contradiction, said, no, we are not accepting this. We're already paying too much in taxes, and it was rejected. And what has happened as a result of that? IMF funding has been delayed. Before the World Bank does an approval, they do what they call a staff visit. So their staff come into the country, and they have dialogue with the National Treasury officials, the central bank. So they were in the country in September, and they had discussions. And those discussions, let nobody cheat you, is what are you going to do about your revenue raising measures? Because if you're not able to raise or to show us that you're able to raise more money, there is no more funding that's coming due. So the IMF is aware. As much as they have been accused, and rightly so, of sometimes careless lending because of political, considerations, they get to a point where they say, we can't just lend you without knowing how you're going to pay back the money. So we're already in that situation. So it's a current issue.
Out of curiosity.
Yeah.
So why is it the shilling crashing? They're still at 129, 128, against the dollar.
Okay.
So what explains that strength?
So for me, I think there was a bit of an overreaction when the dollar shot from around 100 all the way to 160. And that was driven by fear and concerns around the maturity of the 2 billion euro bond. So once that was resolved, then we saw the markets kind of breathe a sigh of relief, and the dollar rate then kind of steeply corrected down to what is now currently a level where it appears to be very stable at around 130 shillings to the dollar. And based on that and my insight into the markets, I think the dollar inflows into the market are pretty good. And also there was an element, a small element, where people were hoarding dollars, and especially the large corporates. But again, it was justified because you probably have an expense coming up in US dollars, so you don't want to sell all your dollars into the market. So when the rate fell, it also drove some panic selling. Some people came into the market instead of loading their dollars. So now there's a free flow. At around 130, I think the market has come to a dynamic where there's a balance between demand and supply. I think at 130 shillings, the dollar shilling rate has now found some stability. I think the move towards 160 earlier on was driven by fear that there could be the event of a default. So the market overreacted. It happens. So once that was resolved, we were able to go back into the international markets and issue the Eurobond that paid off the maturing debut Eurobond. Then the markets kind of relaxed, and the market found now a stable ground. The other thing that makes the shilling depreciate is the price of oil. And there could be a risk. The conflict that's happening in the Middle East, the conflict between Israel and the Palestinians, Gaza, it's a genocide. And I don't know what people are saying about that. That continues to happen. It's very unfortunate. The thing in terms of geopolitical risk is that conflict is now escalating. We're seeing Lebanon now coming into play, the Hezbollah in Lebanon throwing bombs into northern Israel, Israel retaliating, and we're seeing, in fact, as of yesterday, Israel again. I mean, this is I think the third time that they've bombed some southern cities in Lebanon and killed some Hezbollah leaders. So there is cause for concern. This conflict is getting out of hand. Today morning, we saw the United Nations calling for a 21-day ceasefire. As that is happening, the conflict is still going on. So if that happens, that's the Middle East. That's where our oil comes from. If that continues, then we could see price of oil going up. If the price of oil goes up, then we'll have an impact on the Kenyan shilling. So that's the way I see it. Yeah.
Yes.
That's a risk that we're facing.
Let me turn back to the question of investments, and I want you to comment on the size of the Nairobi Securities Exchange, and the fact that there has been no public listing for a very long time.
Okay.
And the general smallness of the capital markets in Africa. And then we will turn on to the issue of private equity.
Okay.
I want to ask a specific question about that later on. Yeah.
Okay. So for the Nairobi Securities Exchange, specifically is talking about stocks. This year has actually been positive because if you look at the main indices, they're up between 10 to 20%, depending on which indices, which index you're looking at. So this year, 2024, has been a good year. Previous years, I think 2023 was negative, and that was because foreign investors were bailing out again, tied to the Eurobond. Yeah. Now that issue was resolved, we've seen foreign investors coming back. So when you look at what drives the securities exchanges, mainly the foreign investor, board. So when you see activity on that side, and they dominate in terms of the volumes. So they're coming back in, but their play is limited in terms of which counters they're going into. And I think there is a bias right now on financials, that financial sector, which, I mean, when you look at the results on a quarter basis, they're doing pretty well. The other thing we're seeing is standing head and shoulders above the rest is Safaricom. Safaricom took a hit in 2023 during the expansion into Ethiopia. I think they underestimated that environment there. The license fees that they were required to pay was exceedingly exorbitant. I think something like $150 million, if I remember correctly. So they took a bit of a knock. The market hasn't peaked as quickly, but 2024 is turning out to be a better year for Safaricom in Ethiopia. In terms of, they got the mobile money license. Now you have got M-Pesa in Ethiopia. The numbers have increased to about 5 million. They now have 5 million M-Pesa users. So that's positive for the stock, and foreign investors are now, voting with their money and putting back their money into Safaricom, which had dropped, I think, from 39 shillings to 15. We're seeing it now beginning to rebound. That's a good investment. So stock exchange so far, positive this year. On the question of listings, there's a lack. There's a lack of growth. I think the Capital Markets Authority, but specifically Nairobi Securities Exchange, they've been challenged. They've been challenged even by the political class in terms of what's happening. The last time we had a listing was, more than 10 years ago. So why aren't we getting these companies? I would think, like, the bid cause, maybe they don't want to let go of their shareholding. But there are some companies that are ripe for going public, but they don't have to. But I think that could be attributed to the fact that we're not also being able to attract new companies to come and set up shop in Kenya. And I think we've had, there's a textile farm that was based in Nakuru. I won't mention the name of the company, but they shifted their base from Nakuru to Uganda because Uganda set up an export processing zone. The cost of power in Uganda was down to 7 US cents per kilowatt hour, whilst in Kenya the cost of power is about $17 to $19 per kilowatt hour. So based on that, and then the benefits that they were getting from the Ugandan government in terms of tax holiday for 10 years, reduced tax even on imports. So we've seen also flour companies leaving Kenya, going to Ethiopia, and again the incentives being offered there around, power, around government incentives, tax holidays. That has been a major positive. So there's that accusation that Kenya has probably not done enough to attract new businesses which can then list on the Securities Exchange. I think that is valid. And I'm also reminded that there have also been allegations of corruption where companies wanting to set up here are always being asked for kickbacks, so they opt to go to other countries. And I think one country that is a shining example of foreign investment is Rwanda currently. But all these are allegations that add up to the fact the outcome tells you there's a problem. Why we don't have new listings at the Nairobi Securities Exchange is because we don't have new companies setting up shop in Kenya. So the outcome tells us there's a problem and we need to do something about that. Yeah. Maybe just to mention, there was a study, I think last year, 2023, that showed in Africa, Kenya was the largest destination for private equity investments. I think in 2023, we received about $800 million in private equity investments. So that's a positive. Okay, now getting into your questions, is this good or bad for us? So there's the rules of the game. This is capitalism. So capital is always looking for the best return. Capital does not discriminate based on the color of your skin. It doesn't discriminate based on your religion. Capital is simply looking for a return. And where capital sees a positive or potential return, capital will move there. Capital is allocated on the basis of return. So we have to decide whether we want to play the game of capitalism or we want to play protectionism, where we say these are our companies, we will retain them as efficient as they are, with the little capital that they are, and will stay as a closed economy, maybe like North Korea as an extreme example. But if we're going to play the game, then we must open up the market completely and allow private equity, and that we have done. And so for me, there is not a negative but a positive when I see private equity coming in and taking over Equity Bank, or even Neighbors for that matter, isn't it? Yeah, Neighbors, I think the family have sold a huge chunk of their holding in Neighbors, and they continue to reduce their stake. But that shows me a Kenyan-grown company, that has been able to set up shop, attract the interest of foreign investors who have come in, and they want to play a part because they can see there is a return in this market. So I think we just have to decide. There are positives and negatives. Yeah. So you lose what you would consider, your companies that are emotionally connected to, Kenyans. But the truth of the matter is that even Safaricom, a huge chunk is owned by Vodafone, yeah, isn't it? Go to East African breweries, yeah? BAA2, yeah? Our Pride and Joy, that's owned by Diageo, yeah? So wherever you go, we can't avoid the issue of private equity. It's part of the game that we're playing called capitalism, and it's a good thing when capital votes to come to Kenya. It means that we're doing something right. Financial services sector, we've been able to build up our commercial banks, Kenya Commercial Bank, there's Equity Bank, there's Cooperative Bank. All these banks are now regional banks, yeah? They're in South Sudan, they're in Uganda, they're in Rwanda. Recently, KCB and Equity are in DRC. So we are spreading our footprint across the larger East African region. So that's good for us, even as much as we're saying equity also has a component of maybe IFC lending and private equity. But still, when they're able to derive profits from the DRC and from Rwanda and from that comes back home because the majority shareholding is still somewhere in Kenya. So on the one hand, okay, when you get private equity coming in, their drive for return is extremely vicious, and they will cut costs. So that could be one of the negatives that happens because they are very, very shrewd in terms of the way they operate. So they want to ensure that the organization that they are buying into is operating as efficiently as possible. So one of the first things that you'll find as the company is growing is that headcount becomes an issue. So layoffs, and they're sad. They're really, I'm not advocating for that, but there are plus and minuses. And maybe one of the minuses is that as this private equity comes in, they want a return for their buck, which maybe results in a more efficient organization. But again, it goes back to driving value for the shareholders. But then again, how do you play that so that the employees also get something for the work that they do? So it's a balancing act. The reason I put commodities in the book is to help to enlighten Kenyans of what's happening outside in the world. Help them to know, whilst we're not there yet, this is an area which I think even the Capital Markets Authority is looking at in terms of helping to develop our commodity markets. And the best thing about the commodity markets is that it provides a place where farmers, and here we're talking about whether large-scale farmers or even small-scale farmers, are able to get some assurance in terms of the value of the produce that they are producing. So, for example, this is the way it works in the States. A wheat farmer has a price, a break-even price that they have for the wheat that they're going to sell maybe in 3 to 4 months when the wheat is ready. But they're not assured where the price of the market will be in 3 to 4 months. So what the commodity market does is that it allows you to purchase a product called a commodity futures product, which gives you assurance in terms of what your price of that wheat will be in 3 months when you go to harvest. So it removes the uncertainty for the farmer. Yeah, that product called the futures commodity product helps the farmer to know, I'll be able to sell my wheat at a certain value on maturity or on harvest, and that will guarantee me a profit going in. So before they even plant the seed into the soil, the farmer has a contract in their pocket, and they know worst case scenario what the price for that product is going to be. So we're not yet there in terms of commodities. I know we have the coffee exchange and the tea exchange where we sell our tea and coffee, but that is a spot market. It's just an auction. It's really just an auction where we sell our coffee. But if we're going there, and that's why I include in the book, where we move now into a developed commodity market, where we are now dealing in futures. Yeah, it's like a forward contract for a future date, and we begin to offer that to clients, and people are able to go to the exchange, buy a futures contract, like I've explained, and get that assurance that come harvest, I'm assured that this is the amount of money that I'm going to get because I have this contract, in my pocket, and it assures me that on maturity date, this is what's going to happen.
There's Ray Dalio.
Yes.
He says that the transaction is the basic unit of an economy.
Yes.
So I've always wondered, does this mean that Safaricom is indispensable to our economy? Because I imagine most transactions in Kenya are handled through M-Pesa than through cash or banks. What would happen if Safaricom were to collapse?
There is a point. That's a valid point. I agree with you. That is a valid point. What you're saying is that the Kenyan economy is predominantly reliant on Safaricom as a mode for settling transactions.
Yes.
And that is a fact. Therefore, if it's a fact, it's also a risk. And I think we've witnessed a few occasions where not M-Pesa, but the undersea fiber cable.
Mm-hmm.
We're always told it's the cable which has been disconnected or something, where the data goes off and the whole country goes into some sort of Wi-Fi blackout, and we can't communicate with the rest of the world. So there is an over-reliance on Safaricom, and that is why we have the Communications Authority of Kenya, the CAK, who is a market regulator for telecoms, who should then come in and be able to put in place some sort of regulation where you create competition, some sort of fair competition. But this subject goes both ways, because when we begin to say we want to regulate Safaricom so that Airtel Money can grow, then some people will argue that you want to penalize success. Because Safaricom started at around the same time as Airtel. Was it cancelled back in the day? They started at around the same time. So how come one company has succeeded and another one has fallen back? It's because, in my view, Safaricom has had their ear on the ground. They've listened to people, yeah, and they started with the like for per minute billing, and they said no, we'll do per second, yeah. They also reduced their airtime to as little as 5 bob, but here they want to reduce that to even a shilling. Mm-hmm. Yeah, so they're listening to the market and they're alive to what's happening in the market. So they change, they adapt, and they succeed. And now when they succeed, we are saying, and because there's a risk, because if Safaricom goes down, as you said, then the Kenyan economy is affected. We need another player in the market who is equally as large, who we can turn to in case Safaricom goes down. But then when you do that intentionally, that means you're bringing down Safaricom, then it's like you're punishing success. And you're punishing them for their innovation. Yeah, so it's a very delicate balancing act. And it's not only the Communications Authority of Kenya, because CAK would regulate the telecom side of it. The mobile companies have now been forced to separate their telecom business from their finance, so money transaction business. The M-Pesa and the Airtel Money are now separate companies within those, and they have a reporting line to the central bank. So the central bank actually is the one to call the shot here and decide how do we manage the risk of Safaricom being too big to fail. I think we've had that from America during the financial crisis. So Safaricom has become too big to fail. It cannot fail. But woe unto the day Safaricom M-Pesa goes down, then this country will just grind to a halt, which is very unfortunate. So we need to do something around. But the question is now, how do we do it? How does the regulator, which is CBK, come in and start to prop up other players so that they at least have, even if it's 25% share in the market or 50% share, so that in case of anything, people can switch to an alternative. So there's a risk where we're saying some sort of concentration risk. Yeah, there's concentration risk, and it is a reality, but it's something we need to continue just asking, how do we best manage this without seeming to punish a company for succeeding in the market. Yeah.
I saw a Kenyan on Twitter tag Elon Musk asking him to buy Airtel so that he can outcompete Safaricom. Is that really something advisable to have a foreign player come in and take over that way? Is this a threat to Safaricom?
I wouldn't even look at it that way in terms of Elon Musk buying Airtel. Elon Musk is already here through Starlink. Yeah? Mm-hmm. And he's not only here, he's across the globe. Yeah, and he's going to all the countries. So, I mean, his current offering has sent shivers to Safaricom. We've seen the way they've reacted, and it's just a bit unfortunate. It's a bit of a panic. But yeah, they should panic. Absolutely, they should panic. But for us as consumers, we should be least concerned about who the person is or where they're from, as long as you get a good Wi-Fi connection at an affordable price, and it's reliable and it's stable and it's not interfered with during uncertain times, you know.
But the question is around the transaction thing. You see the M-Pesa, Airtel Money. Around that issue, if the transaction is the basic unit of the economy, it means the economy is dependent on its transactions.
Yeah.
So whoever controls the platform that has the transactions controls your economy.
Absolutely.
So don't you think, you see, Safaricom has 35% stake, the government, 35 Vodafone, 5% Vodacom, 25% the stock exchange. So to a large extent, we have some control.
Yeah.
as a country.
Mm.
Don't you think it's a national security threat to us
Mm-hmm.
if a foreign player were to come in, 100% owned foreign,
Mm-hmm.
and outcompete Safaricom in mobile money?
Absolutely, yeah, it would be a risk. But even now, we already have a risk. With Safaricom holding the lion's share of the market, there's already a risk there. So the ideal situation would be to have 3 to 5 players in the market, each controlling about 20-25%. Then you have a balanced out economy, so that if one player went down, then they're not, what we are saying, too big to fail. Yeah. But the scenario we have right now, whether it's Safaricom or whether it's a foreign player, Safaricom still has a dominant stranglehold on M-Pesa transactions, or transactions, economic transactions, let's call them that, because that's exactly what they are, because every transaction, goods and services are changing hands. Yeah. So that's already a risk, and I want to kind of more focus on that. And that's why I'm saying now the regulator needs to come in and find a solution to that will help to open the market to other players or existing players for them to grow and catch up, but do it in such a way that you're not penalizing Safaricom for being successful and innovating and adapting to the market. Because when you regulate to bring down a player, I don't think that is fair. These people came into the market around the same time. They set up shop around the same time. One player has grown and advanced because of their innovation and the hard work that they've put in. The other player has not been able to adapt. So the question is, and I agree with you, that there is a challenge. There is a challenge. If Safaricom was to go down, it would be catastrophic for the country. Yeah. But then the question is, how do we address the dominant shareholding? And I think in other markets, and I think in Europe, there's issues where the European Union has come in and said, I think there was a ruling on Microsoft back in the day about antitrust, but that was a case where Microsoft was using unfair trade practices by locking their software and not allowing other players to ride on their software. And I think that antitrust went through. But in this case, it's not an issue of antitrust. It's a case of where one player has just become dominant by fact of innovation.
What about crypto? Crypto could be a solution, maybe. Like if Safaricom, whatever it has done, the reason it's dominant is because of the costly infrastructure needed to set up that franchise model of M-Pesas all over the country. Maybe with crypto as a innovation, another company could probably do it with less resources.
I don't think so. I'm still convinced that Safaricom and the data that they have, the network that they have currently, if somebody came up with an alternative product, Safaricom would be able to copy that product
True.
and make it better. I just have a feeling Safaricom will be able to do that. So it doesn't depend whether it's crypto or not. Safaricom has such momentum right now, and mass, and they're bringing to the game all these previous history of being in the market. They have their dealers already in place. They have an unfair advantage. But did they acquire it unfairly? No. They played by the rules, but now they're too big. It's a risk, and it's a risk. I don't know whether we live with it or how we address it, but I really don't have an answer to it. But I know at some point you need to start. It's like, okay, the referee has to interfere with the game to some point to help the weaker team here. Okay, that's not advisable in football. But in this case, so that you have, so that the whole economy benefits, and you reduce the risk of this entity that is too big to fail. To reduce that risk, you have to play unfair to them and give some incentives to their upcoming. I think there are other players that are coming into the markets. The smaller players, especially the microfinance. And this is, I don't know, maybe there's room for them. Their ability to advance credit is not the only thing that they can do. I think there's room also for money transmission. And there are few companies here and there, but very small again, because Safaricom has a stranglehold. The remaining bit is held by Airtel. And that's why we need to have, I don't know, I really don't have a solution to it, but I know it has to be regulatory, because Safaricom will just continue to dominate unless there's some unfair interference in the market where you help other players to grow, with a view just to reducing that risk of too big to fail. Yeah.
I've noticed that when it comes to the startup culture, or the startups in not just in Kenya but on the continent, most of the foreign direct investment goes into fintech, financial technology.
Absolutely.
And mostly it's lending money.
Absolutely.
Are they just using Africans as a, I don't know how to put it, but they see us as
an experiment of some sort.
Not experiment,
Yeah.
but we just mint money for them, so they give us loans, but they take back more money, right?
Okay.
Isn't there more that they can see in us?
Absolutely. I think there's much more we can do.
Yeah.
I think there's much more. I think, I mean, maybe the example of, I mean, Uber came in, they set up, they're doing pretty well. Bolt has come in terms of ride-sharing apps. And I think a few other players are in the market. There's Farasi, I think some local entities are coming in. So there's space to play, but I think the reason you're seeing most of the activity in terms of private equity going to fintech is because of the return. Again, capital. What dictates where capital goes is the return. And I think the companies that are established are being able to offer an outsized return to their shareholders, and therefore you're seeing private equity, because capital will go where it will get the best return. So that's not something we can really regulate. But I think in terms of, are there other areas where we can play? Absolutely. Yeah, there are many other areas, but I think as the economy continues to grow and develop, I think Kenya is, in Africa, we're best positioned. We already have a perception advantage in the global market through M-Pesa, and everywhere you go, people are talking about M-Pesa. There is a Konza City, Technopolis, that's being set up. That's a major hub, and even just individually amongst Kenyans, the innovation that we show in terms of the products that we're able to provide. I think there's a bias internationally for people to come to Kenya and see what's happening. So I think that will continue to happen. But like you're saying, yeah, we need to have some sort of diversity, not all the money just going into fintech. But then again, like I said, capital is only driven by one thing, and that's the return, the maximum return it can get for its shareholders.
You know, we have like a negative attitude towards the loan apps as Kenyans.
Yeah. But
also, I remember in school we learned that finance is the lifeblood of a business. So if we didn't have these loan apps around us, wouldn't it like lead to the cash supply that the local businesses need to survive to run out, right?
Absolutely.
So it could be a good thing, yeah? These fintech apps.
There's a plus, there's a major plus. The ability to access credit is crucial in any economy. For the economy to develop, access to credit is absolutely critical. And especially for business owners and microfinance, small and medium enterprises. Previously, that is a segment that was not well catered for by the banking sector. because you go to the bank and you're required to provide 3 years of audited accounts, certificate of incorporation, a lot of requirements which most of the microfinance companies are not able to deliver on because they're not registered, they don't have audited accounts, they don't have an accountant, they just operate day to day. So the fact that these fintechs have come up, and they've come up with a system where you're able to do your transactions using that app. They can monitor your transactions for 3 to 6 months, see your cash flow, what is coming in, what is going out, and then based on that, again, some computer program or an app is able to determine that based on the cash flows that we're seeing, we can give you 10,000 for the month or 20,000. So that's a smart way. And the banks have not been doing that. So the fintechs have come up, they've taken over the space. Kudos to them. Absolutely fantastic. So for the businessman who is out there and previously could not access credit, now they can access credit. The question is, and I think, which is what we've discussed previously, that the central bank needs to address is what rate are these companies charging the microfinance? Are they unduly taking advantage of them? Yeah. So we need for the central bank to come in, and they have to regulate that space. I think they relicensed all the fintech companies, especially the lending, and now they are regulated under the central bank. So that is already in place, and that's a good thing, so that you're not taking advantage because this person has no alternative, and then you're charging exorbitant rates just because you want to make a return. No, I think the central bank has come and put his foot down and said, no, that's not going to happen. We're controlling you, and this is how you're going to go forward. So I think that's a positive development.
So my last question.
Mm-hmm.
Right now we are in let's say the third year or the second year of this new administration.
Mm-hmm.
So looking at the policies they have been coming into place with, whether it's taxation, whether it's fiscal or monetary or whatsoever, do you think the private sector is being looked at the same way the Kibaki cabinet was working with the private sector? Yeah.
Absolutely not. Absolutely not. I think there is a major divergence. If you're saying Kibaki and the current regime in power, no, absolutely. I think with one, you had a listening ear and an acknowledgement that government cannot do this alone. Yeah, whilst government is the biggest spender in the country, the business of government is not business. Business of government is administration. And creating a conducive environment for businesses to operate in. And the way you do that is you give business an open ear. You listen to them. You hear what they want. Of course, you don't give everything, because they probably don't want to pay tax. No, that's not possible. So there has to be an open door policy where the government is saying, look, for the economy to grow, private sector has to come on board. Yeah, let's work together. Let us know what you require, whether it's the cost of power, whether it's taxation. What is it in terms of policy that the government can do to enhance the environment that you're operating in, so that you guys can grow? Because the government of business is not to create employment. No. But in Kenya, somehow we believe that everybody needs to work for the civil service. Absolutely not. The government needs to take a back seat. Understand, yes, you are still the biggest spender in terms of infrastructure development, which again also helps to facilitate an economy where people are able to move from point A to B. They're able to operate. So you're providing education, you're providing healthcare, you're doing the basics, you're also providing security. So when people are able to acquire wealth and property, that there's law and order in the country. Yeah. So that's the government's role, is to facilitate for the private sector to come in and thrive. Yeah. So comparing the two regimes, I think there's right now people are not listening. The current leadership is not listening, and as much as I want to blame them, and there is blame that is to be allocated to them, there is also the issue of our current debt situation, where, like I mentioned earlier, we are not totally in control. We're in a place where we need funding from the World Bank and the IMF. And I think even everybody has said we need to borrow. We can't borrow, but we need to borrow because we are in a fix. Yeah. So who do we go to right now? It's the World Bank and the IMF. And they gave us the conditions. You saw the Finance Bill 2024. Those conditions were put in place by the IMF. Already, like I mentioned, the funding that was due in September, $600 million, is not forthcoming. Why? Because we have not been able to demonstrate as a country that we're able to raise additional revenue to finance the loans that we're going to get from the IMF. So there we are stuck in a catch-22 position.
So we need to borrow.
We have to borrow.
But the conditionalities of the loans that we are being given will kill the private sector or the economy.
Absolutely.
So
Catch-22.
Why then do we borrow?
We are so deep in the hole. We are so deep in debt.
Do we have to borrow from the IMF?
The question is, what other alternative do we have?
Well,
the Chinese have refused to extend further credit. The railway is stuck at Naivasha.
Okay.
It's not stuck in Naivasha because that was the destination for the railway. No, because the Chinese have said that's enough. First pay off that. Yeah. So we're in a catch-22 situation, but where you imagine 70% of your pay is going to debt. You don't even have money for food. You don't have money for rent. I'm looking at it as an individual. You're in a situation where you just have to borrow.
I hear you.
Yeah.
We need to borrow
Yeah.
so that we can survive.
Yeah.
Yet, at the same time, looking at the people in government, they don't look like they are in dire straits. They are spending the money poorly. They are spending the money on lavish things. They are spending the money on non-essential things, and also enriching themselves. So, to a Kenyan looking at our leaders, the economy doesn't look bad if they can afford to do that.
I agree with you. And I have this to say: the money we have as a country is not sufficient to pay our debt and entertain corruption. There is no leeway. There's absolutely no leeway for corruption right now. But from what we are seeing in the newspapers, what we're hearing in the news, it's business as usual. Like John Githongo said, it's our time to eat. That's the political class. That's how they think. That's how they relate. We are now in power. It's our time to eat. So nothing has changed. And like I said, I think for the IMF, and this idea has just popped into my head, but I think it has been something I've been ruminating, thinking about, is that before any lending comes through, I think we need to go through some serious structural adjustments in terms of the spending that the government is currently engaged in. And even as you look at spending, because we have to cut down, we really have to cut down on spending, on unnecessary expenditure. And new projects, we can't have any new projects. We need, first of all, to focus on reducing our debt and get it to a place where we have some breathing space. So for me, I'd say the first thing that the IMF needs to do is to look at how the government can cut spending and how you can reduce corruption as much as possible. Because the money that's been taken out is money that is so badly needed to just pay recurrent expenditure, not for development. Not that money is not even, there's no money for development. It's just for recurrent expenditure. But even that is being stolen. So for me, I think I'd change my tune there and say, okay, fine. Even before you do revenue raising measures, can you first look at the current expenditure? Can you look at the current budget? Yeah. Where is this money going? We've just been looking at education, where we're saying there's a bursary for the MP, there's a bursary for, I don't know, the governor. And they've put all that money together and said, if we take this money and give it to education, we can be able to do all the things that we need to do. But when you take the education budget and split it and give every elected representative a bursary, it doesn't make sense. So it needs to be an overhaul of the entire budget and look at the loopholes, because there are many loopholes. I mean, we've had scenarios where the former president was saying government is losing 2 billion shillings a day. And that's the president saying that. And he doesn't think there's something wrong with that. He knows the money is going, and what is he doing about it? Where does the buck stop? Who's responsible for what? So Kenya, and I think people have said, and I'll quote Willie Mutunga said, this is a bandit economy. And Kenyans on Twitter are saying Kenya is a crime scene. And I totally agree with them, because nobody cares. At this point, nobody really cares. Because if you can steal money in an economy that is going down, and you can see clearly it's going down, you came into office saying the coffers were empty. If the coffers are empty, what are you stealing? There's no money to steal. What you're stealing is what will collapse the economy.